Exactly. Good afternoon. We're taping from Silicon Valley. My name is Randy Williams, proud member and also the founder of Keiretsu Forum. Great year this year. We're celebrating our 16th anniversary, and we're going to go over 1,000 fundings this year. Typically, we fund over 100 companies throughout the world. We all started in Northern California 16 years ago. We're at 42 locations or chapters around the world, and we have great leadership from Beijing to Istanbul. And today we have another rock star guest with us, and we're going to be talking about angel investing, but more importantly, what are angels actually realizing on their investments in regards to their return. Matthew Le Merle has written a white paper, so let me, he wears many hats, so Matthew, please introduce yourself and tell us what we're talking about. We have two segments today. The first segment is, but introduce yourself first.
Great, thanks a lot, Randy. So I'm Matthew Le Merle. I've spent about 30 years here in the States, first as a management consultant, working with big financial institutions and companies on issues of strategy and operations. I've worked with State of California and sovereign entities on strategy too. But about 20 years ago, I became an active venture capitalist and then angel investor. And it's the angel investing hat that I'm wearing today, both with Fifth Era, my own firm, and with Keiretsu Capital, where we have a fund, which we'll probably talk about later in this interview.
Okay, the first segment, we're going to be talking about your white paper that you published, and the co-author, I think, is very cool. He's a University of California, Berkeley resident, and he happens to be your...
My son, Louis Le Merle, who is at Berkeley, as you say, UC Berkeley, studying economics, business, and real estate, is the co-author of this report.
Well, proud parents, and there's many proud parents listening to this, we all want our sons and daughters to be involved in hopefully helping shape the next, obviously, generation of entrepreneurs. And hopefully, Louis, years from now, he's going to be a successful entrepreneur that we fund at Keiretsu Forum. So tell us about what you created and the significance of it. So please tell us the title first of the white paper.
Yes, so this paper is essentially synthesizing the research that's been done into the asset class angel investing. There are a lot of asset classes in the US, public markets, securities, stocks, bonds, real estate in various types. And for the most part, there's a lot of information, data analysis on the returns from those other asset classes. In the case of private equity, institutional investors back private equity firms and venture capital firms, and so they also expect a lot of information, a lot of analysis of the returns from those classes. Angel investing is a little different. It's very large, about $24 billion a year in the US. However, the investors are individuals, and as a result, the only data and analysis we have are some very high quality academic pieces of research. And so this report, we essentially read and scrutinized all of this body of research that's been done by professors across America and internationally, and tried to synthesize their findings around the returns of angel investing.
Great. And I do recall one wonderful professor, actually two have come to Keiretsu Forum over the years to share their statistics. Hopefully you spoke to them. I'm speaking of Dr. Wilbank. You talk to him?
Exactly. So Professor Wilbank, who works very closely with the Angel Capital Association of the US, is one of these people. I think you're also talking about Professor Jeffrey Soule from the University of New Hampshire, who also tracks a lot of statistics about angel investment in America.
Okay. So let's dive into the findings. Tell us what you or your son found out.
Well, yes. So as a 20-year angel investor, the first question that I'm always worried about is, are we making a good return on the investment? Pretty much all of the research is very consistent in finding that angels do get a very good return on their investment, typically in the mid 20% IRRs. According to Mason and Harrison, who began this body of work back in the early 2000s, they found that in the UK, the returns were typically in that range, mid 20% IRRs. Professor Wilbank's work in the US is that US investors get about a 2.6 multiple over about 3.6 years, which is a 20% IRR. In the UK, he found that the return was also very good, a little bit lower, about a 22% IRR or a 2.2 multiple over about 4 years. So very consistent. Angels get great returns for their investing.
And so how does an angel get a return that's exceeding 20%, which seems very high, because obviously as we enter into this year, 2016, there's a lot of storm clouds, obviously, in the financial or the public markets. So how can we look at the private markets and still get those returns?
Exactly. So, so when you break apart that's the overall return. By the way, when you take a look at it, adjusting for the time value of money, the angels actually get a slightly higher return than venture capitalists, about 70% above the risk-free rate for angels, as against in the high 50% for the VCs. But when you break it apart, what you basically find is that the failure rate of angels is actually quite a bit lower than venture capitalists. For those deals that return no capital, angel investors have about 40% of their companies return no capital at all, complete failure. Venture capitalists, conversely, have more like a 60% rate of complete failure in their portfolios. At the other extreme, when you look at success, the angels and the VCs are very similar in the sense that when you look at deals that get a 10x multiple, so they return 10 times the investment or better that the angel has invested, both angels and venture capitalists get between 7 and 10% of their returns as companies returning more than 10x, depending upon which research we look at. So the way we get the returns is a lower failure rate, a similar type of success rate to the venture capitalists, and about 75% of our total return is driven by a relatively small number of companies that get a very good outcome.
And so how do you access a company or companies to get this return? Because obviously it has to be diversification to get that. Because you can't, I mean, you certainly get hopefully 10x one company, but you can also lose 100% of your money. So how do you actually get that weighted return, Matthew?
All right. So straight away you've made a very good point, which is the way that both angels and VCs get their return is very dependent on a small number of very successful outcomes. There is a consequence to that, which is just statistically, in any population of angels, some angels will not get those very high returning companies. And in fact, Professor Wiltbank shows that about 39% of the investors in his sample didn't get a return of their capital. So because a relatively small number of deals are creating most of the return, you do in fact need to be highly diversified. Researchers have recently shown that there is diminishing returns on the number of deals that you need. If you have less than 10 or so deals, you have a relatively low probability of getting the angel return. By about the mid-20 deals in your portfolio, you're getting close to a high, 100%, well, it's about an 80-90% statistical probability that you'll get the angel return. You get into diminishing returns about 40 or so companies. So the answer to your question is diversify, place investments in a large number of companies, and have a high probability that you'll get the angel return, which is very attractive.
Well, I think in segment 2, which is going to be right after this, we're going to be talking about how to hopefully get those returns, be diversified, and hopefully have your portfolio exceed 20%. And it's not easy, but there are techniques which we'll share. But let's drill down on your study. And what was a period of time that you looked at this? This study was, you just completed it. It's over the last 10 years, 20 years, and tell us the body. I mean, sometimes studies is predicated on really getting great content and information statistics. How did they get all this information?
Exactly. So so that's a great question, Randy. And just to clarify, this is a synthesis of other people's work. Angels really in the US came into existence at the end of the 90s. You launched one of the first angel groups around about 2000. And so the bulk of this research really didn't kick off until angel groups were beginning to get quite well established. So I had mentioned before the work by Mason and Harrison, that's 2002. Wilt Bank started his work in the mid-2000s and has published a number of reports, and his newest report will be coming out in just the next couple of months, and we all look forward to seeing the results of his most recent analysis. But most of the research is looking at angel investing in the last 15 years. This is a relatively new asset category, and people are just now beginning to get to grips with the issue. And the attractiveness of the category is really very consistently found by all the researchers who look at this space.
And so it's incumbent on all angel groups and also angels listening to this. Please report, your liquidity events. Report what you have capitalized, the company. Failures, it's important. And we started doing this. We are 16 years old. We started doing this year 2. And reporting on our returns, reporting on our funding stats. In fact, we'll be reporting on our 2015 this next month, all throughout our chapters throughout the world, what happened and what type of results did that our members realized. Do you believe this? Do you believe that you can actually realize over 20%?
So the answer is absolutely yes. In the second component, I know that you're going to ask me some questions about my personal investing activity, and this is my experience too. The reason I did this research with Louis was more than anything that I wanted to understand this category as a class. All of the research that we've looked at by academics focused on this space is very consistent in finding the same sorts of returns. For me, at least, the big call-out from this work is the diversification call-out. When I started as an angel investor, I made a small number of investments. They built over time, but it's really difficult to get to portfolios of 30 and 40 angel-backed companies, and yet that's where the benefits of diversification are really felt. And conversely, if you don't get up to those numbers, you're leaving yourself exposed to the risk that you will just be unlucky and not get a high probability of the angel return. And
so how does one, and we're going to be in segment 2 really drilling on this, but I just can't wait to ask the question, how does one actually find those great opportunities so they can be diversified? And that's what we're going to talk about in the next 15 minutes. But whet our appetite, because who doesn't want to find that? I mean, a gentleman stood up in our Keiretsu Forum meeting today, and he's had 2 very, very seminal, very exciting liquidity events. One was over 20x, one was a 13x. And, he was sharing how it occurred, what happened, but he also had 2 losers too, but he's still over 4x on his capital. So, whet our appetite for segment 2.
So let me answer that question from the academic perspective. So Professor Wilt Bank, who we've mentioned a couple of times, works very closely with the Angel Capital Association of the US, and he, on his most recent research, did some breaking apart of the deals to try and figure out what drove the higher returns. And there's 3 important drivers that I'll mention right now. The first is, does the angel group do very deep due diligence? If an angel group working together, the members working together, do their own...
Now, we only have 30 seconds.
All right.
And I know we're going to be covering segment 2. So you have 30 seconds to tell us number 2 and tell us number 3 in the next segment.
So the answer is deep due diligence, deep industry expertise, and really working hard to make sure the company succeeds, the whole angel group helping that company as a group.
Okay, so stay tuned. This is Keiretsu Forum Presents. This is great topics, great content every month given by rock stars and also Keiretsu Forum members and also general partners of funds. Thank you.
Thank you very much.
It doesn't seem like we covered anything.
No, we covered everything.
Yeah, I know. But
we did, except that you asked me the last question and I ran out.